All right, I will just kick things off really briefly, and I know we'll have John from AWS up on the screen momentarily, but I'm David Easthope. I head up the FinTech vertical within our market structure and technology team at Coalition Greenwich. My perch and perspective is very much as an industry analyst, which gives me kind of the purview to not necessarily talk any book in particular, just my thoughts and insights, and I'm very happy to be moderating today. And I'm going to let my panelists introduce themselves before we kick off. May.
Thank you. Hi, I'm Zabaneh, head of product at PayPal in the crypto part of the unit, which is the blockchain, crypto, and digital currencies.
Shawn Douglass, co-founder and CEO of Amberdata, the leading provider of institutional data for digital assets.
Jeff Hasselman with Blockdaemon, formerly of AWS. And I'm the president there, leading all of our sales, corp dev, corp strategy.
Thanks, Jeff. And we also, we're scheduled to have John Liu from AWS. Raise your hand back there if he's going to be joining us on screen. Yes or no? Stand by. Okay. Jeff, you may be on call for the AWS perspective.
I think I could speak to it.
You can. You can be dangerous. Perfect. So just to kick things off, one of the things, as I mentioned, is at Coalition Greenwich, we conduct industry research, which includes the annual institutional adoption study by Fidelity, but also most recently a report that we just released in partnership with Amberdata that we're very excited to talk about briefly. If you have a chance, you can go to Amberdata's booth. You can scan the QR code and get a download of that report. There's a nifty way to do that, so please go see Amberdata if you can. One of the things that we've noticed through that research is just the growing seriousness about institutions and their approach to digital assets. The representation of that is putting people, actual persons, not necessarily wallets or assets, but people into seats. And so now about 25% of asset managers and hedge funds have a dedicated person whose role is specifically focused on digital assets, which we think is a really good indicator of kind of institutional focus and adoption in one segment of the institutional marketplace, which is managers. And I should mention, as we think about institutions on this stage, we are thinking broadly about banks, merchants, hedge funds, other institutions, corporates. So we'll be speaking very broadly about institutions. But one of the things certainly on the table here is that DeFi is a little bit different. DeFi for institutions is a bit of a leap. For many of them, they live in a world of BSA, AML, KYC, name your acronym, know your token. They very much view themselves as an intermediary. They plan to stay intermediaries. And they often engage in things like reconciliation across partners, across clients, and across ledgers. So DeFi obviously offers that single shared ledger, the ability for instantaneous settlement, all sorts of those wonderful things that can now be applied to traditional financial assets, real-world assets. So DeFi is a bit of a leap, and I think this panel is certainly skilled and experienced dealing with those regulated institutions that know how to approach this sector. And so I really want to just kind of kick things off. Jeff, if you wouldn't mind, just taking that sort of industry-wide approach on what do institutions need? How do they actually scale and get real high-quality, institutional-grade infrastructure in place? Jeff.
Ooh, starting off with the infrastructure question. So what I would say, the big thing when you think about the infrastructure and as it relates to institutions, it's all about collaboration and community. What are we doing to work together? How are we helping each other out? And one of the things at Blockdaemon where we're helping connect those institutions to blockchains. How do we do that through infrastructure? What are we doing in a number of fronts as far as how do we cover over 50 chains. So what can we do to help you get into that aspect of the world? And the big thing when you think about institutions for us is there's a number of pieces that go into it. Is it regulated? Is it not? What tools, what reports do they have? So the way our tools have been built out is to really help those institutions make it easier. We do it's basically a one-touch integration into those 50 blockchains. So that's one way to look at it. There's multiple ways I could go with it, but just to give other people on the panel, and I know John probably can speak to this too, not to steal his thunder from the AWS side, but the one thing that really is that I've seen, I'll go back the last 12 to 24 months, the conversations that we've had with the largest banks in the world, the largest media and entertainment companies, those types of players, they've all come asking, we need a Web3 strategy, what do we do? And we find out very quickly within the first few minutes, is it 101 or 401 levels to where they're at? And we can help them in any way. But the thing is, we're helping them. And that's where the community comes into it as far as how you look at that with the tools that they may need to take that to the next level. The thing that I've really seen that's really encouraging too, when you think about institutions as it relates to infrastructure, that has really kind of resonated with me is the questions that they're asking are much stronger. I go back, I've been in the crypto world for 10 years. And when you think about back to 2017, 2018, that winter, you couldn't touch an enterprise. Like they just wanted to stay away. Very few did it. But the questions that they're asking now are much better. And that's what's making this industry even more in vogue as far as what's taking place. And then the follow-up to that I'll close on is as we head to the Bitcoin halving next year, this will be the first Bitcoin halving that we've ever had where the enterprise actually has a Web3 strategy and they're thinking about it. So the prior one, we did not have that. Yes, there are a handful of companies that were doing it. But overall, it's a bigger play. So it's how do they get into it, what's going on, and from a Blockdaemon standpoint, what are we doing to kind of set up to make sure that we can take care of them in any way that we can?
I think I could add to that from an Amberdata perspective, institutions, I mean, crypto's actually been around for quite a while now. We're like 10 years in. So I think the early adopters, they're still early adopters, but we're really moving across the chasm. Think of the old Jeffrey Moore crossing the chasm into the late majority. And the late majority in institutions are looking at digital assets as this is a global platform that I can create financial products and provide financial services to the world. Decentralization is a byproduct of the delivery mechanism by which they can connect to. And as institutions come from TradFi, they have expectations on how do I get my data? And for example, market data, it's incredibly more complicated than I connect to New York Stock Exchange and NASDAQ, right? There's much more. There's 30 major spot exchanges that matter. There's 6 or 7 different derivatives exchanges, and to be able to connect to and get the quality, the value, the velocity, the frequency of market data and insights that they need and they expect as an institution is really hard. They don't want to spend tens of millions of dollars to do that. Add on top of that the complexity of blockchain data, because a blockchain it's a database, it's an application server, it's an incentivized crypto economic mechanism that incentivizes behavior. You need to understand the telemetry of all of that to understand time series, who held what when, what's the accounting. You need to understand what are the incentives. You need to be able to understand those are the fundamentals for the valuation of these digital assets. It's incredibly difficult. So as institutions, they expect to have that like they would get from a FactSet or a Refinitiv or a Bloomberg. And it doesn't exist except for companies like Amberdata who've been building this out for like the last 6 years.
To piggyback on that too, it's like not only are they looking for that information, but then you have to tap into all their different legacy systems that they have and figure all that out. So how do you make that simple for them to make that take place? So that's a place where Blockdaemon can help out. Yeah. And I know Amberdata does the same thing, absolutely. Having worked with you for a long, long time.
May, what do you think?
So I think just to build actually what you guys were saying, we're kind of in both unique positions. So we really believe in like the simplicity and the security from a consumer customer base to help them from like traditional ways that they're used to engaging and bringing them then into the crypto ecosystem. And then on the flip side, it's also like we obviously are partners also with other institutional infrastructure players. So our custodian is Paxos, for example. We work with Blockdaemon, and there's many other partners that we actually also rely on. And then on the third part, which is we think of ourselves as a two-sided network. And so when we think of an institutional broad definition of merchants, we actually also help them in things that they would need in order to navigate within the crypto ecosystem. And there's things, as you already actually called out, whether it's on the compliance front or security, or it's ease of use, or it's a broad access to a customer base, or it's just like high payment authorization rates. It's the things that the strength of PayPal and the payments expertise that we've actually developed and decades of experience that we've built on that we can actually bring into this. And so one like particular example, which I'm actually thrilled to announce today, is that we are live on MetaMask with what's called our off-ramps product. And that is actually a continuation of enabling on and off ramps onto crypto. So from a consumer perspective, it's really easy for a consumer to use PayPal on the wallets or the dApps in a seamless way, in a trusted way for them to be able to buy or sell their crypto. And then for our wallets and partners and providers, we're actually providing now access to this broad range from PayPal, who has access to millions of users, as well as then high industry authorization rates, and then taking away all this complexity that exists around the payment and the transaction and being able to apply it there. So we're super thrilled to announce this today, and obviously please check it out. It's live today on MetaMask.
Congrats. It's exciting.
Thank you.
Do we have John? Guess not. So I think if John were here, he would definitely mention the role that AWS plays in terms of providing some of the managed services. There is actually a webinar or a podcast that he just did around their query tool and other managed services they offer. I would encourage you to check that out since he's not here, unable to join for technical reasons. Let's actually, by the way, there was so much buzz about stablecoin product market fit. And you were mentioned, so I know you weren't in the room, but seems like that is definitely a theme for today across institutions. Let's just pivot quickly into the regulatory context because we have to address it. It was definitely discussed clearly on the general session with a combination of policymakers and regulators. Shawn, I think that part of our research points to some jurisdiction shopping or perspective on that. Maybe you want to just tackle that. Who's offering a good framework for the communities and the builders out there? Like, who's giving you some optimism about that?
Yeah, so I think that the regulatory framework has evolved significantly around the world. I think the U.S. is a little slow to follow, for sure. I think that we'll get there, and a report, surprisingly, is pretty clear that everybody believes that we will become leaders again. Where we're seeing a tremendous amount of clarity is MiCA in Europe, in the UK, in Singapore, in Hong Kong, in Dubai, in Abu Dhabi. And it's interesting is today in Singapore, there's 15,000 people at a conference there. Like the US, we don't have that. It's the people who put this conference on, they do a phenomenal job and they've had bigger attendance. People are going to where they're welcome. And I think that the regulatory frameworks that have been put in place are pretty clear around the world. And I think, as was mentioned in the report, we will get there soon, I hope, in the United States. And I think that will create a massive opportunity for growth. I think that regulation's important to kind of prevent this fear of you're going to go to jail or you're going to get this wrong or you're going to get a fine, right? But I think that it's really critical that we get past where's the safe place to do crypto, which I hope is soon because there's 8 billion people on the planet and about 70% of them have mobile cell phone access, and digital assets enable the financialization of the internet, and we can bring financial services and digital assets to every single person on the planet that has a phone, and that's going to transcend local regulation. So I think that the key is let's get the regulation in place so we can all build businesses and create economic value globally.
Before I throw it to the panel, what Shawn's referring to is if you cast your eye to the horizon out the next 5 years, there's a surprising amount of enthusiasm and optimism about the U.S., even around the ability of the SEC, the CFTC to quote unquote maybe get their act together, get a little bit more harmonized. So take a look at that report. I think it's also telling that people generally based in the U.S. want to stay here. They want to see their country succeed. They want to have roles and jobs around DeFi and crypto that are based here. They don't necessarily want to fly off to Singapore, even though it sounds like a great conference there. I'm just going to ask Jeff to weigh in on this as well. What are your thoughts?
Yeah, when you think about the crypto thesis or ethos, it's all about it's global. We transcend geopolitical thoughts. And the thing when you start thinking about places where restrictions are very tight or the regulatory system is very tight, these people that are builders, they're moving. And you've seen places all around the world where it's picked up. Shawn mentioned a couple of them. There's more that are out there without going into too much detail. But what I will say is that that's never going to go away in this ethos. So it's like it's going to find its way wherever it goes. So from a U.S. standpoint, yes, obviously there's things that are taking place, but reading the report you put out, and I do suggest everyone should read that. It's very well written. There's definitely something going to happen here. But I can speak a little bit back on my AWS days from developers that were leaving the US. That didn't just happen in the last 6 months. That's been happening for 12 plus months. So it has been happening. So it is one thing that you need to be paying attention to as far as what's gone on. It will evolve, but I'll get back to it. That's just the ethos of crypto. It's what this whole thing has been built about, is how do you transcend those political lines or any kind of line that kind of ties into that.
May, what do you think about the climate, in particular, what's going on with the stablecoin legislation? Obviously, you're tracking that closely. What are your thoughts there?
Yeah, I mean, we do obviously believe that payments are, the whole power of payments and community is all that it is, in a sense, borderless. Like, it needs to connect people across the world, whether it's when you think of things like remittances, cross-border payments, just commerce transactions, connecting merchants to consumers across the world. And so this is something we strongly believe in from a payments perspective and innovation throughout that. And that's why we're also, obviously, last month, we were thrilled to announce that we had launched our own stablecoin, which is stable. It's regulated. We believe, obviously, strongly in U.S. innovation and strengthening kind of our position throughout the world within this industry. And there's absolutely a role to play. We're transparent. As I mentioned, we're regulated, and it's extremely unique because it's the first of its kind, that a big two-sided network which serves so many millions of consumers and merchants around the world to launch this stable cryptocurrency. And we think that this is just the beginning. There's still a ton to do. The benefits of the distributed ledger technology that it brings to the table, which is reducing the cost or increasing the speed across these transactions across the world, is extremely meaningful and brings value to the ecosystem and to the players. And so we're really looking forward to see how we build this out and how we continue to build on this.
I think that's going to be very interesting to see your new stablecoin, all very exciting. I think clearly very timely with what's going on in the marketplace today. We're often reminded, you look at the top assets by market cap, and there they are. They're up there. Like, you can't, unavoidable, as was mentioned, product market fit, as was mentioned in the previous panel. One thing, I just want to go back to the regulatory thing, because I can obviously sort of speak a little bit more off the cuff. I think one of the things that's missing from the discussion is, you mentioned MiCA. That doesn't necessarily impact DeFi as much. Obviously, that's more about crypto, digital assets. But one thing that I think is going on is that is focusing attention here more on the US. With MiCA being announced, I think it's putting pressure on some of these regulators and policymakers to do something. I also think the FCA in the UK, with their sandbox environment, proposals, has a very strong role to play as well. So it's not just Singapore and Dubai. So I think there's a lot of really good momentum on the distributed ledger technology side, in particular, these sandbox environments that allow people to experiment, to tokenize assets, knowing that full well that their legal and compliance teams are on board from the beginning, not asking for permission at the end.
Yeah, I think one point on that,
Yeah.
I think it's really important, and I think this is a misnomer that the crypto world gets, is that people have never thought of regulation. And going back to the very early days, if you were a startup that was not thinking about regulations, and you made one mistake, you're pretty much poof. And it's like, that's the part to me that it gets a misnomer, so it's a very top of mind for everyone. Now the question is, what is the sandbox? What are we playing in? How do we look at it? So I think that's a point that just needs to be, how do we keep pushing forward and be good actors? Yes, we've had some bad actors recently, and that's happened, but that's happened in other industries too. We're not the only industry that's ever happened to. So from that standpoint, it's just think through the people on the stage. We're all thinking about regulation all the time. So we're definitely, and having big teams thinking about it.
Yeah, I want to add to that as well. And it's interesting, whether it's the FCA or it's VARA or ADGM or MiCA or whatever, pick your favorite framework. Yep. They all have a core piece of that is stablecoins. And stablecoins is the killer app for digital assets. And I'm not trying to steal your thunder here. You can add to it. It is the killer app. And if you think about all of DeFi is denominated in some type of a stable coin. And furthermore, most crypto does not trade in US dollars. It trades in /stablecoin of your choice. So by them regulating consistently, which they for the most part are, I think, on stable coins, there's less clarity around some of the DeFi lending yield, et cetera, not like yield, I'm thinking more yield is DeFi yield, then I think that's a serious path. It really is. I don't know.
I think it was also, Hester mentioned the future of exchange, the definition of exchange, which I think was a juicy little nugget, perhaps underappreciated. These communication protocol systems or CPSs, which is grabbing more of these RFQ and other platforms, and I think it is encouraging liquidity to go offshore to the decentralized exchanges. However, that doesn't mean that they can't come back. I think that's the one thing. Hey, there's John.
Hello, everyone.
You
Sorry,
popped
I
up.
couldn't join you.
You popped up. Have you been listening?
Yes, I have.
Okay,
Finally got
wonderful.
that sorted out.
Well, glad to have you, and everyone can see you now up on the screen. I want to give you a chance just to introduce yourself and talk about your role, and I'll go back and revisit one of the questions because I want to make sure you have a chance. Please go ahead, John.
Yeah, John Liu, head of product for Amazon and Web3 blockchain services. Been at AWS for about 2 years now, leading the product strategy for blockchain. And prior to that, I spent probably 5 years in public blockchain at public protocols, distributed applications, really focused on kind of the product strategy as well as the business applications in the early days of innovation. And before I was in blockchain, I spent about 18 years in traditional finance, both as a trader, trading bonds and CDS, credit default swaps, so really the most illiquid, inefficient instruments you can think of from a settlement standpoint. That's what I was dealing with, which probably is why I wanted to look at blockchain as a way to increase the efficiency of trading those instruments. So that's a little bit about me.
Thanks, John. I guess we should have used Chime and not Zoom, right?
You know ours too well.
Wonderful. Well, I wanted to give you a chance, kind of going back to that first question about scalable infrastructure, because I know that's a huge part of AWS and your recent announcements on managed services. Do you want us to talk a little bit about that?
Yeah, when you think about financial institutions coming into the space, they really just have a different bar when it comes to availability, reliability, and security, which is one of the reasons why it takes so long for them from the outside to move into the space. It's like, oh, it's 3 years, it's 4 years. Now why are they finally doing custody? Because they have to put a lot of these into place. When you think about the availability, they need to both at the transaction submission level as well as the data reading layer, right? So that's where we're helping customers a lot. If you want to submit a transaction to the nodes, everyone here, to the blockchain, everyone knows you have to connect to the blockchain using nodes. So if you're a traditional financial institution, not only do you have to connect to one of those nodes, you have to connect to clusters of those nodes because you certainly don't want your transaction missing, just like any other decentralized application. However, you have an additional layer of disaster recovery that you have to factor in. So it's not just in one region where you want to send these transactions to, you probably want to set them up across different regions, which is why we launched Access in 6 different regions. And financial institutions are using this, as I mentioned, for disaster recovery, as well as preventing localized attacks, localized 51% attacks. Like, these are the thoughts that they have to actually work around when they're enabling cryptocurrency custody solutions and trading apps at a financial institution level. And then from the data layer, you always ask, well, the data is already there, right? It's on blockchain. Why is there any need for some type of data service? We have to deliver this data in sub-second latency to the applications, because if you open up your financial application today, like any mobile app, and you want to show the balance and transaction history, you're pretty much used to, as a consumer, for example, loading it in probably half a second. Doing that with the blockchain data stored as it is actually quite difficult. There's a lot of extract, transform, loading, caching, parsing of logs that need to happen in order to serve that information to the end consumers of these traditional financial institutions. So again, we provide that for them. Just basically take out all that undifferentiated lift to make it easy for financial institutions to build with cryptocurrency products.
Wonderful. Obviously, we have Amberdata up here, so the data element has been a big part of it. One of the areas we're seeing as well at Greenwich is just the explosion of data and spending. So it's very much a healthy market, and crypto is definitely no exception to that. I think that's both the market data, the on-chain data, all the DeFi data. So John, how are you differentiating between the different data sets there at all? Are you supporting all of those?
Yeah, we're starting with on-chain data. We like to always start with little steps out for basically the foundational information that people care about, like balances and transaction history. And as the financial institutions get more comfortable supporting the different assets, we're going to start with Bitcoin and Ether because that's what the financial institutions have cared. I'm sure in the earlier sessions that's been brought up a few times. So we start with providing that basic information. Then there's probably going to be off-chain information that needs to be weaved in. And certainly, just like with Amberdata, you have traditional financial instruments information that you probably want to weave all into the same space. As I mentioned before, we're focusing on the on-chain data to start.
Do you want to weigh in on the regulatory climate? Any thoughts there?
Yeah, I'm not sure what's been covered before, but it's definitely been an uneven regulatory adoption, right? And certainly it's been a little challenging in the US, but we are seeing more clarity in the European region and in the Latin American region. I really like what I'm seeing in that front. In Brazil, for example, they just passed one of the, in June, I think, they just passed their virtual asset regulation, which is clearly defines what a virtual asset provider is going to be regulated on, and also what assets they won't be. It is quite interesting. They exclude things like loyalty tokens, right? Now, they still have to go through a lot of KYC, AML, a lot of that compliance standards is still there. The main difference is there's clarity on what they can do and what they cannot do, which is one of the challenges that we're kind of working through here in the US.
It's interesting. You mentioned Brazil. I don't know if all of you saw the headlines. Now Brazil, Russia, and China are all piloting CBDCs, and it was mentioned in general session that we are now looking to propose legislation to ban them in the United States. So interesting to see kind of different courses on the central bank digital currency side. Bringing it back to the panel, I think we kind of glossed over the infrastructure piece. I think maybe we'll go back to sort of the technology stack, Jeff. Like what else are institutions really needing? And they're really going into the sort of the frontier on staking and governance. Like, are they getting involved in that area, or are they leaving that to, in the same way you'd leave, certain things to, you're running a fund and you leave the corporate actions and leave that to somebody else. Like, you can't deal with that. You can only touch, the underlying asset. But tell me a little bit more about, like, where is the frontier in terms of technology adoption on the infrastructure piece?
So there's definitely a number of places where they are. And Blockdaemon has been taking care of them for a long, long time. So when you think about node infrastructure, as far as what happens on that side, really the staking aspect of it, there's certain plays there where institutions have been big customers of ours for a long, long time on that side. As you drill out a little bit further, the way I look at this is, let's think bigger as far as where could this go? What does this look like? And this goes back to what I said earlier about the last 12 to 24 months. The kinds of conversations that we're having, what's been taking place, where those companies are in that journey, and what that looks like. The thing is, when you think about the last year, we've had a lot of bad things happen in this industry. The questions didn't go away. They actually upped the ante as far as asking more questions. Yes, right now they may be a little bit slow in making decisions. That doesn't mean they're not thinking about it and they're not working on it. As your report says, the 25%, I think that number is going to continue to rise, as you call out in that report. But it is one of those things that we're very attuned to what's going on. Blockdaemon is the only company out there from a startup perspective that's been venture backed or funded that has the biggest banks in the world, from JP Morgan, Citibank, Goldman Sachs, throw SoftBank in there. We're the only ones that have that. So it's very interesting how we bridge that gap as far as where that is. And that's our ethos of what we look at. That's our mission. How do we connect those companies into this world and make it easy for them? That's the challenge. And it goes right back to a little bit what John was saying there. This is not an easy approach for those companies. So what can we do to make their life a lot easier as we move forward on that? There's a number of different places where we can go as far as how they're using it, what they're doing. But the one thing that I will say is that innovation is there and it's happening. And I think we're just at the beginning of this game, which, even though some of us have been in it for a long time, it's still just the beginning.
I think I'll extend on what Jeff said. Go up the stack here. So if you think about what is infrastructure to enable the adoption of digital assets and enable people to build businesses on it, for us, what we're doing is we're solving really hard data problems And it actually follows the adoption curve. If you think about the entire value chain for financial services, usually starts in the front office. People want to trade stuff, people want to research stuff, people want to build portfolios of the stuff that they traded, right? Then it's like the natural progression from there is, I need to understand what's my risk of holding these things? What's my variance from peg in a stable coin? What's the flows, the velocity, what have you? And so Treasury cares a lot about that. Move to the back office. And it's like, hey, I traded this, how do I account for this? How do I account for my staking yields? How do I account for, I got liquidated over here. Oh, I have, trading on 30 different exchanges. How do I map that all into, some type of a securities master so that I have a categorization and then I have a reference rate and I know what the reference price, because the price of Bitcoin where, when, on what exchange, and guess what? This market looks a lot more like FX than it does equities, in that there is different prices around the world at different times. So you have to know what is the reference price to settle that. And then you go further back office, it's like, okay, how do I pay my taxes on this? How do my auditors account for what I say that I'm doing? And how do I enable the regulators? Because guess what? All the regulators are buying the same data that the front office is now, right? They have to, because if they don't have the same data that the front office has, then the stories don't line up and everybody wastes a bunch of money in court. So the regulators are coming in and leaning in and have the same data demands as the most leading edge front office multi-pod hedge funds. And if you think about that, it's pretty profound in our adoption, but it's really having, you have to be able to have the blockchain node infrastructure to be able to stake, to be able to send transactions, receive transactions, et cetera. But then you need to be able to extract the value, the data across the entire value chain and not spend years and tens of millions of dollars doing that. You want to just be able to pay a subscription and get access to everything that's happening in the crypto economy. And I think that's the key in that the financial infrastructure is, at the end of the day, the world is all about data today. I mean, obviously, I have an opinion, but maybe.
And Shawn, if I could add on to what you just said there, one big change here is the data is widely available for everyone to use now, right? It's there, but unlike the closed financial systems, as you pointed out, where people were kind of finding their own truth and then finding fund administrators then to find the right closing prices, there's almost this source of truth that you have to align to, but making that data easily accessible, right, is where we can help the regulators and the institutions a lot.
Yeah, it's incredibly complex and it's expensive and hard to do, and that data is invaluable. And digital assets is radically transparent, far more transparent than any TradFi exchange. Period. Full stop. Especially when you have, you have to go in through a clearinghouse or whatever. You have no idea really what's happening, but in crypto, there is composite transactions. Somebody can do a trade that's an arbitrage trade that does a flash loan into Aave, which then settles into a stable coin. And oh my God, like, to be able to parse that, it's elegant, it's highly valuable, it's needed, but it's not easy. And there's very few people in the world that can do that, and that's why we have a really good business. So.
Any thoughts on that, May?
I think it's just, at the top level, it's all about extracting the complexity and providing the simplicity back to whether it's the institutions or the consumer base that really needs it. And so when you think of, like, with PayPal or Venmo, we extract all the complexity of just buying, selling, holding, transferring into the PayPal and Venmo wallets, and we make it really easy whether you're a crypto-curious customer or whether you're actually a lot more of an enthusiast. And it's just providing, again, it's extracting and making things simple and seamless, taking away a lot of the hardships into getting into the space and just making it easy to bridge into that ecosystem. And then the flip side, again, for the institutions and the merchants and these businesses, Web3 ecosystem and providers, it's how do we provide them with, whether it's tools, data, access, ways to be able to seamlessly integrate with services to kind of participate in this economy without taking on a lot of that complexity. And a simple thing like I'll bring up is we launched about a year or two ago this feature called Checkout with Crypto. So essentially any consumer that has crypto in their PayPal wallet can actually access now millions of merchants on the PayPal network to check out with their crypto basically what they do is they sell it. It's in a simple way, it gets sold, and then it transfers into fiat, and that settles to the merchant. Now, the merchant in this equation, because of the way they've integrated, had to do nothing in order to get that. What they did now is offer a lot more choice for their consumers in the way to pay, and the merchant had no lift on an integration. It's a future-forward integration with a partner they already trust for payment processing. And so I think these are just like small examples of just ways that we can continue to build and continue to drive people and help them to access a lot of this world that gets complex, extract that out, and make it simple for them to kind of navigate in this.
Excellent. I think we're running out of time here, but I will throw out one last question, and that is really, we haven't talked as much about tokenization, and I like to think of it as sort of this theme of the tokenization of everything, whether it's collectibles, art, VC, private equity funds, money market. Why don't you just crystal ball real quick, like what's going to happen with tokenization? Because it feels like crypto, you mentioned, Shawn, we're how many years in? And then tokenization feels very much like the first inning. So, John, you want to take that one, and then Shawn will throw it to him as well.
I'm laughing a little bit because, this is almost like a second life of tokenization. If you were here in 2018, tokenization was obviously a very big driver towards like, here's all the possibilities that, blockchain can do with digital assets. You can tokenize buildings, and there were certainly a lot of efforts to tokenize those buildings. And it's taken a while to set out. What I think is a big difference this time around, you have the underlying trends of better regulation and protection in place, KYC, AML, custodians, all that we've talked about. And there's also these assets, I think, that's found some more traction. I like to go back to government bonds, right, as a good asset to tokenize. It's transparent in the sense that people understand it from both the traditional finance side as well as more type of the DeFi or new type of finance. And it's got pretty good yield, 4 to 5%, right? So that's a pretty attractive return to bring both sides of the table to use a technology like blockchain. So that's what I think is driving the second wave of asset tokenization.
Yeah, I'd say that's especially around the nexus of the UK and Europe, where we're seeing the big banks come together to do that. Shawn.
Yeah, I want to add to what John is saying. So on two things, John earlier talked about securitization and credit default swaps, because at the end of the day, some of this people don't want to say it is, but it's kind of securitization, right? And you're creating these tokens, but what's the value of that? Why do people do it? For me, it's like, what's the incentive? Because incentives drive behavior. That's what you have to focus on. So John called out one thing, it's yield. Stable coins today, ironically, are the 12th largest purchaser of U.S. Treasury bonds in bulk. That's pretty radical. Like, wait a second, people are, because the U.S. exports dollars through petrodollars, through eurodollar markets, through everything. There's a huge market for U.S. dollars and U.S. dollar yield. You're unlocking that to, you got to bank through a big bank to any person with a crypto wallet can now get yield that they previously didn't have access to. So it's enabling people to generate yield. Two, it's the taking illiquid markets and making them liquid by tokenizing, securitizing, whatever you want to call it, and bringing that on chain so that you can fractionalize ownership. That unlocks real estate. That UBS just did a bond on public Ethereum. KKR's did, there's a ton of these. The tokenization of real world assets. I think that will continue. Fast forward 10 years. Forget about the 18 months because I have no idea. But 10 years, that's going to be a thing, because guess what? Somebody else's database. Nobody wants to trust that. That's how public markets work today. Is it's somebody else's database. Crypto is global. It's transparent. It's fluid, it's liquid, and you can bring the best of traditional financial services in a way that can touch every person on the planet. That's what's really powerful.
I'll take a little different twist on that. Just because, these are all great ideas. I'm a former hockey player, so I kind of look at Wayne Gretzky of always skating to where the puck is going. So from that perspective, I'm like, how do the institutions hold on to these assets, no matter what they are? What does that look like? And that's where Blockdaemon, we have a wallet that can do that. So those are the things, what can we do to kind of put that in place to make sure all those institutions have what they need to, no matter which way, because I think every idea you brought up are awesome and they're being worked on. So it's like, how do we make sure those institutions are in, especially with the way this conversation has gone, how are those institutions in the right place to make sure they take care of that?
I think we're done here. Okay. Thanks, everybody. Thank you to my panel.